Welcome to our High Rock monthly video for May. I'm Scott Tomlinson, and with me on the call today is our portfolio manager and founder of High Rock, Paul Tepsich. Let's start off by talking about financial markets in April. Little bit of volatility towards the end of the month, Paul, but for the most part, things most markets were higher. And led by Canadian equities. Looks like balanced portfolios were doing quite well. Anything you want to point out here? Anything that stands out to you?
Well, yeah, for sure. The one thing in the bottom part in yellow, Canadian preferreds, which we will talk about when we go through the fixed income model.
Excellent, excellent. That's great.
But
just
yeah,
as
actually,
we
one more thing, Scott. Sorry, I would add too. It is kind of interesting that through the month of April, that equity markets actually performed quite well, given that we had in the US 3 or 4 very, very large bank failures, certainly from an asset-based perspective. And I think we talked about them before, but they were actually much larger than any bank failures in the global financial crisis in the US. So it's a sign that there is some sort of resilience in the equity markets, that it kind of brushed off these massive bank failures. That would be the only other observation I would have.
Yeah, no, it's interesting, and I've got a little bit of slide with the global equity model that I'll point something out that I think will be somewhat interesting to our clients. As I suggested, balanced portfolios also did quite well, and balanced portfolios, for the most part, have done well on the year. We look at the iShares Core Balanced ETF portfolio to provide a bit of a comparison so that our clients can look at their portfolio and see how it's doing on a relative basis. Again, everybody's portfolio may be slightly different, so if you want to get into more detail, that's probably a conversation that we should have. If you have time, we're happy to have these conversations whenever you're comfortable doing so. But let's talk maybe a little bit, Paul, about our special mandate and the high yield model that you work with. Anything to report of significance there?
We had one bond, which we used to own in the balance mandates, Crew Energy, which is a natural gas producer, that was entirely redeemed by the company just right at the end of the month, April 28th. So those, we didn't own it in the balance mandates. We did own it in the high yield mandates. That bond was taken out, gone at par. That worked out really well over the last few years. We did add, and we added it in both the high yield mandates and in the balanced private client mandates, a new bond, which is Cineplex, which I'm sure everybody that listens to the call will be aware of. They've had a really good rebound in box office revenue, people going back to the movie theaters, and hopefully this Writers Guild strike doesn't hurt them too much moving forward, but have an excellent rebound. So that bond yield, when we bought it, it yielded around 8.5%, and that helped replace for both special mandates and high yield mandates. It helped replace some of the yield loss and some of the bonds like Crew that was redeemed, as well as other bonds like Ensign Drilling we sold back in February.
Excellent, excellent. And as always, everybody's portfolio is different, a function of their specific goals and their specific long-term goals. So if anybody wants to, obviously we want to have these conversations about your portfolio whenever it's convenient for you, but we always want to have them. So if you have some time, we want to make sure that we're focused on the right things. So please engage. Let's talk a little bit about economic stuff, Paul. We've been focusing on inflation a lot lately, and how central banks have been responding to that. The Bank of Canada raised interest rates pretty heftily until recently. Inflation is starting to come back into or work towards their targets. They're sitting now on the sidelines, basically. And of course, we have the U.S. Federal Reserve up today. In fact, we'll see, and we expect them to raise interest rates, the Fed funds rate, by 0.25%. They're a little behind the curve on fighting inflation, but we expect that they're going to catch up pretty quickly, correct?
Yeah, I think so. I mean, these are two great charts, and quite frankly, we've been taking advantage of them since back in October, November, when we started adding to our interest rate risk. Now, don't forget, Scott, just confirm with me, the black dotted line is the overnight rate, that U.S. federal funds rate and the Bank of Canada rate, correct?
That's correct, yes.
Yeah,
So
people,
the controlled Bank of Canada rate and Fed funds rates.
right. So, and one thing we should probably mention to our listeners is that when we talk about interest rates, oftentimes people do talk about the overnight rate, the Bank of Canada rate and the U.S. federal funds rate, but that goes out from overnight all the way out to 30-year government bonds. So when we said we were getting long or buying more interest rate exposure over the last 5 months or so, it's not necessarily in the overnight part of the curve. It could be well out of the curve. It could be in the 5-year, 10-year, even 30-year. And we did do that, and we continued to do that over even the past month. And because quite frankly, those rates have gone down, which means the prices of those bonds have gone up. But these two charts, my view is, boy, oh boy, inflation is coming down in the blue line in both, I think. And another thing we could have shown is, if you look at the last 3 months, that it peaked in June of 2022, inflation in the US. But if you look at the last 3 months, you can see it's gone down. If you look at that annualized, it's just over 3%. So when we knock off April, May, and June inflation rates, I think we're going to see that thing a lot lower. And quite frankly, it could be darn close to 2. That overnight rate is going to start coming down. And the other observation, just by looking at the chart, is we've really never seen the overnight rate climb at that steep a rate. You can look at the one previously, went up like in more of a staircase fashion, even back, pre-global financial crisis. It's never gone up that much that quickly, nor is inflation, not since the early 80s. But so I think the central banks will, if we're right on inflation, they'll turn very quickly. But it's going to take one of two things, and that is the inflation rate to keep moving down very quickly, and economic weakness or something else to break, which I think we talked a little bit already. They already kind of broke the regional banking system, but their own fault, the bank's own fault, in my opinion. And we may have a commercial real estate problem going on as well. So there are things that could break that will force the Fed to cut rates quickly. And today, I'm recording this at 12:45 on Wednesday, May 3rd. The Fed will come out at 2 o'clock in about an hour and 15 minutes or so. Widely expected to hike by 0.25%, but also widely expected to be the last one. So we shall see, Scott.
Yeah, absolutely. And it's also, we look at it from two perspectives. We look at interest rates from an investing perspective, but we also know that our clients who have mortgage or mortgage debt may have maturing mortgages. So it's often a conversation that we have with our clients as to where the best place to be to renew, what term, and certainly what rate. And obviously the overnight rate impacts the prime rate or the variable rate more aggressively than a longer term rate like a 5-year. So again, these are conversations that we're always happy to have with our clients if they have and want to get our opinions on what we think will be happening to those mortgage rates over the course of time as we move forward. Okay, let's talk, as I said before, the global equity strategy. We haven't really changed a lot. We did buying in through the sell-off last year and at the beginning of this year. And something that I think is really rather interesting is that once again, earnings expectations are leading stock prices. Something that stopped happening after the pandemic began and central banks put significant amounts of monetary easing into the system, which drove all asset prices higher, including stock prices, but perhaps unrealistically so because they got well ahead of earnings. And you can see the dark blue line historically has tended to lead the light blue line, which is S&P 500 prices. And it looks like we're back to that again. And as a result, we're reasonably comfortable with how we're sitting with our equity exposure, our global equity model exposure. Paul, do you want to talk about the fixed income strategy?
Yeah, I'll just give a quick update. I already mentioned Cineplex bonds that we bought. I guess the only other thing really to add, Scott, is that we did do a switch trade out of Government of Canada, which was an old tenure when we owned it, but became more like a 6-year. So we rode it down the curve for a number of years, and we moved back out to a full 10-year. So that actually added a little bit of interest rate exposure duration, and we topped up people. We topped up some clients in 30-year Government of Canada bonds too, so that added a bit more interest rate exposure. And then the other one is we continued, and I think we're where we want to be for now on our switch trades out of rate reset preferred shares, which we still own one of. But the other two we swapped out of both fixed rates, rate resets into fixed rate perpetuals. So that added more interest rate exposure. And I think we're where we want to be right now on that side.
And the rationale has been, as you've explained on previous calls, but the rationale for the more fixed rate exposure is a function of longer taking advantage of longer term rates, and the fact that we anticipate that shorter term rates are going to come down in the not too distant future.
Yeah, I mean, the rate resets we had performed extremely well, as rates moved from like 10 and 30-year bonds when they were at 50 basis points or 0.5%, and they got out to 4.5. It was they were great instruments to own. But as rates got there and our views changed back last fall, that we had likely seen the peak, and that the very aggressive, more than hockey stick increase in the overnight Fed funds rate and the Bank of Canada rate would finally crack the economy, crack some markets like commercial real estate and regional banking, that those 10 and 30-year rates would come down. So that's why we did the swap out of rate resets. They served their purpose, and they've performed not very well as rates have come down. So it was a very fortuitous trade.
Excellent. Okay. Well, that's going to wrap it up for the month of May. Thank you for tuning in. Thank you for taking the time out of your busy schedules. We want to always encourage everybody to open conversations with us when you feel the need. We are available, and look forward to having those conversations at some point in time in the future. And if we don't speak to you over the course of the next month, we'll be back with the next video at the beginning of June. Until then, we wish you all the very best, and let's look forward to some good weather.